Today you are going to learn about financing of a company via equity. Imagine you are the manager of a company and the company needs to raise capital to make an investment. You have two options to do so. You can use external or internal financing. In this video, we are going to talk about the tax implication if the company decides to use equity. Equity financing can be classified as external or internal financing. Let's first look at how external equity financing works. New equity can be raised by a company through issuing new shares, for example, via a public offering. Buyers of the new shares inject new equity in the company, which increases its capital so that the investment can be carried out. The injection of new equity itself is tax neutral. But what do the shareholders get in return for their money invested? The corporation can either distribute the profits of the investment via dividends to the shareholders or alternatively retain them. Let's talk about the consequences for the shareholder if the company decides to retain the profits. The retained profits increase the value of the company, and thus, the shareholder value rises. Since the retained profit is not distributed to the shareholder, only the return on investment at the company level is taxed. No taxes arise at the shareholder level. The tax burden at the shareholder level is deferred to the date of the sale of the shares. The company can also decide to distribute the profits via a dividend to the shareholder. Dividends are not a business expense and cannot be deducted from the corporate tax base. In turn, they do not lower the tax base and the profit before taxes. Instead, dividends are distributed profits after the company has paid VAT on the profits. If the profit is distributed to the shareholder, it may be taxed again as part of the taxable personal income of the shareholder. This means the profit may be taxed twice. At the company level and at shareholder level, so double taxation arises. However, many countries have adopted tax systems that reduce the double taxation on profits. You can learn about the exact mechanisms in separate videos on corporate tax systems. Now let's have a look at internal equity financing. We have seen that the company has the option to retain the profits and transfer it into reserves. Those reserves belong to the equity capital and can be used to finance new investments. The company does not have to rely on external financing. The introduction to the different financing options and debt financing are discussed in two separate videos.